Welcome to the Opening Bell Report.
We are really glad you could join us today.
Yeah, thanks for tuning in.
If you're a regular listener, you know our goal is to take a stack of really complex research, dense financial data, varied perspectives, and basically distill them down into the essential insights you need.
Exactly, getting right to the signal through all the noise.
Right. And today, our mission is to examine a specific analysis report detailing a microcap stock that, well, at first glance, it looks like an absolute train wreck.
It really does.
We're talking about Soluna Holdings, Inc. They trade on the NASDAQ under the ticker SLNH.
SLNH, yeah.
And the focus of the research we're reviewing today asks you to consider a pretty provocative question. Could this struggling, seemingly left-for-dead microcap actually be the ultimate sleeper pick?
It is a wild premise when you first look at it.
Okay, let's unpack this because the initial numbers from the data are just stark.
Brutal, even.
Yeah, brutal is the word. We are looking at a stock hovering right around 87 cents. It is down roughly 83% from its 52-week high.
Which is a massive haircut.
Massive. And the market capitalization has contracted to a highly vulnerable $85 million.
Right.
The research is very clear that this company has been fighting some serious cash burn and, frankly, substantial share dilution.
Yeah. The dilution is a huge factor here.
But beneath those ugly top-line charts, there is this fundamental business pivot underway. And it's the mechanics of that pivot that make this such an incredibly compelling case study for you to evaluate.
It really is a perfect example of why surface-level metrics can be deceiving, or at least incomplete, you know?
Totally.
When algorithmic trading models screen a chart that's down over 80%, they typically just auto-reject it. They don't look closer. But the analysis report we're dissecting today outlines a core bull case built on a very tangible physical infrastructure advantage.
Which is so rare in the microcap tech space.
Exactly. What's fascinating here is the specific energy strategy Soluna is deploying. They aren't just, building data centers in typical industrial parks or urban hubs.
Where power is at a premium.
Right. Instead, they deploy modular data centers directly adjacent to renewable energy facilities. We're talking wind farms, solar arrays, hydroelectric dams.
Right to the source.
And their entire model is built around capturing curtailed energy.
Right. And for anyone tracking the energy sector, curtailed power is sort of the persistent bottleneck of this whole green transition.
It's the elephant in the room.
It is. The grid simply lacks the battery infrastructure to store all the electricity a wind farm generates during peak production times. Like, say, a highly blustery night when urban demand is at its absolute lowest.
Everyone's asleep, but the wind is howling.
Exactly. That stranded power literally has nowhere to go on the grid. It is just wasted.
Completely lost.
I remember visiting this massive wind installation in West Texas a few years ago, and the sheer scale of the turbines, the deafening noise they make, it really puts the physical reality of our power grid into perspective.
I bet. It's industrial scale.
You have these colossal engineering marvels churning out gigawatts of power. And operators sometimes have to physically feather the blades to stop production because the grid just can't take the voltage.
Which is economically painful for the power plant.
Super painful.
Yeah.
So Soluna's approach is to drop a modular data center right at the source, right behind the meter, and purchase that stranded electricity at rock-bottom prices.
That behind-the-meter positioning is the crucial part. By co-locating, they bypass transmission fees entirely.
Which are huge.
They are. And to understand the economics here, you have to look at their target end users. Soluna initially built its infrastructure for Bitcoin mining.
Right, the original power-hungry use case.
Exactly. But now they are aggressively pursuing high-performance computing and artificial intelligence workloads.
The new power-hungry use case.
Exactly.
Yeah.
In both of those verticals, power consumption isn't just a line item. It is the dominant operating expense. If you secure power at a fraction of the standard commercial rate, you gain an enormous structural advantage over traditional data centers operating in places like, say, Northern Virginia or Silicon Valley.
And there's an ESG angle here too, isn't there?
A massive one. There is a very strategic alignment with current ESG mandates. Enterprise clients who are training these giant large language models are under intense regulatory and shareholder pressure.
They need to show carbon-neutral supply chains.
Exactly. By running exclusively on stranded renewable energy, Soluna offers these enterprise clients a way to process compute-heavy workloads without blowing up their carbon footprint. They are literally turning an energy infrastructure inefficiency into a premium green commodity.
Here's where it gets really interesting. Because the foundation of this company, as you mentioned, was pure play crypto mining.
Yes.
But the analysis report makes a really strong case that the true asymmetric upside for the stock lies entirely in their transition. The pivot. They are attempting to pivot their infrastructure away from the cyclical, wild volatility of Bitcoin and into the much more stable, high-margin world of AI hosting.
Which sounds great on paper.
Right, but we have to look at the physical reality of that pivot. Because you don't just flip a switch and turn a dusty crypto mine into an enterprise AI data center.
Yeah.
The hardware requirements are entirely different, right?
They are night and day, and that is exactly where the execution risk is heavily concentrated.
Let's break that down for the listener.
Sure. So crypto mining relies on ASICs application-specific integrated circuits. These are essentially blunt force machines designed to do one single cryptographic calculation over and over and over.
They're workhorses.
Total workhorses. They are relatively cheap, they are rugged, and they really just need basic power and basic cooling.
You can basically run them in a hot warehouse with a big fan.
Exactly. AI workloads, however, require high-end GPUs, like NVIDIA's H100s. These are highly sensitive, incredibly expensive pieces of hardware.
30, 40 grand a pop.
Easily. And they require sophisticated networking fabrics, like InfiniBand. They need incredibly precise HVAC cooling systems and entirely different server architectures.
So it's a massive upgrade.
Huge.
Yeah.
Transitioning a facility from an ASIC environment to a GPU environment requires substantial capital expenditure. It is essentially rebuilding the airplane while it's in the air.
Which makes the revenue momentum noted in the analysis report all the more surprising to me.
It is genuinely surprising.
Because despite the extreme capital intensity of that transition, the data shows actual traction. In the third quarter of 2025, SLNH reported a 36.7% quarter-over-quarter revenue increase.
That's quarter over quarter, not year over year.
Exactly, quarter-over-quarter, hitting $8.42 million for the quarter.
Which is real money.
It is. And that brings us to a really striking valuation metric. The research highlights that Soluna is currently trading at a price-to-sales multiple of roughly 0.47.
0.47.
Let's put that in perspective for you listening. Standard data center REITs often trade at 5 to 10 times sales.
Right.
And companies positioned directly in the AI infrastructure boom. They are frequently trading at 20 to 30 times sales. So a PS ratio under 0.5 in the high-performance computing space implies the market is pricing in imminent catastrophic failure.
Or, and this is the bull argument, it implies that the broader market simply hasn't digested the transition from crypto to high-performance computing yet.
A total lag in market awareness.
Exactly. This discrepancy creates what the report identifies as a significant divide in how the stock is evaluated.
The quant versus qualitative divide.
Precisely. If we connect this to the bigger picture, you're seeing a classic standoff between quantitative and qualitative analysis.
Break that down.
The quants use algorithms that screen for consistent historical profitability, clean share structures, upward moving averages.
Things Soluna does not have.
Right. Soluna fails almost every standard technical screen out there. The algos are completely rejecting this asset.
But the human analysts see something else.
Yes. The qualitative analysts, the ones actually reading the specific hosting contracts and tracking the PPAs, the power purchase agreements, at these renewable sites, they are modeling a totally different future.
And the qualitative side is where we see some truly aggressive forecasting. The report specifically cites the firm H.C. Wainwright.
Yeah, their analysis is fascinating.
They currently maintain a buy rating on SLNH, but it's their price target that really jumps off the page, $5.
$5?
For a stock currently sitting at 87 cents. A $5 target represents a staggering 475% upside.
It's massive.
But honestly, considering the float and the capital they need to actually buy those high-end GPUs we talked about, a move of that magnitude seems almost impossibly optimistic. How does the Wainwright brief justify that kind of violent upward repricing?
It's a very fair point to push back on, because a $5 target in the context of their current balance sheet requires a flawless execution of multiple catalysts.
They can't afford any mistakes.
None. The justification rests heavily on the stabilization of recurring AI revenue, and crucially, the validation provided by strategic partnerships.
The Blockware deal.
Exactly. The analysis report highlights their recent alignment with Blockware as a primary catalyst. Now, Blockware isn't just some generic tech firm. They are a major player in the mining and high-performance hosting ecosystem.
They know the hardware.
They do. They facilitate the deployment of massive compute rigs. By partnering with Soluna, Blockware is essentially auditing and validating Soluna's physical infrastructure.
A stamp of approval.
A huge stamp of approval. They are signaling to the broader enterprise market that Soluna's behind-the-meter facilities are actually capable of handling high-tier hardware.
Right.
If that partnership translates into fully booked data center capacity, the revenue multiples could expand rapidly, and that is exactly what that $5 target is attempting to price in early.
So what does this all mean? We've outlined an elegant green energy strategy, a quarter-over-quarter revenue bump of over 36%, an incredibly low price-to-sales multiple, and industry validation through this Blockware partnership.
Sounds like a sure thing.
But it's not. If we look at the reality of the market, the stock is trading for 87 cents. It is a microcap, struggling to even maintain its NASDAQ listing.
Right.
A stock doesn't lose 83% of its value strictly because of algorithmic oversight. There are glaring structural issues here that the research brings to light.
Indeed. We cannot ignore the severe financial distress that caused this valuation collapse in the first place. The primary issue crushing shareholder value has been relentless dilution.
The silent portfolio killer.
It's the absolute worst. To survive the extended crypto winter and to fund the heavy capital expenditures required to retrofit their centers for those expensive AI GPUs we discussed, Soluna has been forced to repeatedly tap the equity markets.
Just going back to the well over and over.
Over and over. They've issued secondary stock offerings at a punishing rate. The outstanding share count has ballooned to nearly 100 million.
Wow.
So if you were an early investor, say buying this stock 2 years ago, your percentage of ownership has been systematically diluted down to a fraction of what it originally was.
And that dilution is mathematically evident when you look at the earnings per share anomaly in the report. This is something that really caught my eye.
The EPS is wild.
The stock is currently trading under $1, yet the trailing EPS is listed at negative $6.99.
Which doesn't make sense on the surface.
Not at all. For those tracking the math, you cannot lose $7 a share on an 87-cent stock under normal conditions.
Right.
That deeply negative EPS implies a history of reverse stock splits, likely executed just to maintain the $1 minimum bid price required by the NASDAQ.
Exactly.
It's a clear signal that they've had to artificially condense the share structure to stay listed, effectively wiping out early equity in the process.
That's a vital technical observation. A reverse split masks the true gravity of the historical share price decline. Furthermore, the operational financials remain highly constrained. They are carrying deeply negative operating cash flow.
They're burning cash to survive.
Right. This raises an important question about their actual runway. Soluna is operating in a very tight, high-stakes window.
A race against the clock.
Exactly. They are burning cash daily just to keep the lights on, while simultaneously trying to finance the rollout of specialized AI hardware.
Which we know is incredibly expensive.
Right. They have to scale those high-margin AI hosting contracts and reach positive cash flow before the retail market simply loses its appetite for absorbing their secondary offerings.
Because if the retail well dries up,
if the capital markets freeze, or if investors just refuse to buy more diluted shares before the AI revenue fully replaces the crypto revenue, the company hits a brick wall.
That dynamic is the crux of the entire analysis report. It is a precarious tightrope walk. Management has to fund the transition without completely destroying whatever equity structure is left.
Spot on.
So let's look at the final verdict presented in the research. The conclusion drawn is that SLNH represents a textbook asymmetric bet.
Classic asymmetry.
The asymmetry here is stark. Your downside is absolutely capped at 100%. If they fail to bridge the cash burn gap, the company could face bankruptcy and the equity goes to zero.
A total wipeout.
But the upside, assuming they can successfully pivot their low-cost green energy infrastructure to serve this exploding AI market, is a multiple of the current valuation. The report doesn't shy away from the term multi-bagger.
Which is a bold term to use.
It is, meaning a return that could potentially multiply the initial investment several times over, bringing it much closer to that $5 target Wainwright put out there.
It's important to frame exactly who this analysis is for, though.
Good point.
This is decidedly not a defensive play. It has absolutely no place in a portfolio focused on capital preservation, dividend yield, or low beta stability.
No widows and orphans stock here.
No. The volatility alone would shake out a conservative investor in a week.
For sure.
But for a high-risk speculative allocation, the mechanics are intriguing. The broader market has essentially priced in a high probability of failure. The actionable takeaway for you, as an observer or a potential investor, is to scrutinize their upcoming earnings reports with extreme prejudice.
What exactly should they be looking for?
You aren't just looking for top-line revenue growth. You are looking for specific guidance on cash burn stabilization. You are looking for a cessation of share dilution. And most importantly, hard metrics on their AI pipeline utilization.
Are the machines actually running and billing?
Exactly. The next few quarters will mathematically prove whether this pivot is a structural reality or merely an ambitious narrative.
The proof will definitely be in the filings. They have the physical infrastructure, they have the cheap power. Now they just have to prove they can operate an enterprise-grade AI facility profitably.
That's the test.
Before we conclude today's deep dive, examining this entire ecosystem of stranded renewable power and data centers leaves me with a rather provocative thought for you to consider.
Let's hear it.
We are constantly bombarded with headlines about the seemingly unsustainable energy demands of artificial intelligence. It's almost always framed as a looming environmental crisis, with data centers projected to outconsume entire nations.
Right, the power grid doomsday scenario.
Exactly. But if renewable energy grids increasingly rely on specialized companies like Soluna to purchase their wasted, curtailed power, providing the critical revenue needed to make the economics of wind and solar farms viable in the first place, does the massive energy gluttony of AI actually become the underlying financial engine that saves and accelerates the green energy movement?
It's a brilliant paradox to think about.
It really flips the whole narrative on its head.
It absolutely does.
Thank you for joining us for this deep dive. We hope it provided you with a sharper lens for evaluating the complex, often hidden mechanics of the microcap market. We look forward to unpacking the next analysis with you soon.
Don't forget to like, share, and subscribe for more.